Well, let me get Hochberg in here then. Good morning, David Hochberg. How are you? David.
Hello, angry man on this phone. Are you there?
I'm there.
There he is. Hey, buddy. How are you?
Good. Maybe Fritz Kagi will drive him over. He's another guy in the witness protection program.
Fritz is invisible. All right, we got a number of topics to get to, but you and I have talked about this before. Nothing makes sense. Nothing makes sense. And the stuff, the math that's supposed to make sense doesn't make sense either. So you tell me, where you want to go first?
Well, I think you got to go. Last time I was on, we were talking about the large corporations like Starbucks that rely on consumers and our listeners' disposable income getting cracked and getting whacked with earnings because our listeners and the American consumers are finally listening to me and stop spending money on things spending money they don't have on crap they don't need. And two different things that came up since the last time I was on. And if I was on more often, I'd be able to share this with your listeners more often. I'm just throwing that out there.
Yeah, just don't whine. Don't whine.
I understand. U.S. manufacturing and service employment has simultaneously, listen to this, contracted for 3 consecutive months. Over the past 20 years, guys, this has only happened twice, during the pandemic of 2020 and during the financial blowout of 2008. Okay, more than 800 companies from manufacturing and service sectors claim that employment is falling, which is ironic because every time we get a jobs report, what do we hear? It's stronger. Data indicates that the U.S. has added 100,000 jobs for 40 straight months, the best streak in U.S. history, which is a huge disconnect between data and what's really happening. And we've talked about this repeatedly. What's happening is listeners are not being able to survive on one income, and they're going out, guys, and getting a second and third job. So when you add that up, the employment numbers look great, but everybody that I speak with that are experts within this sector, right, that analyzes this, they're getting part-time jobs, and there's nothing wrong with that. I salute all our listeners to do that, but the numbers are skewed, and it looks like we're growing with employment, and we're not. Okay, it shouldn't count. There should be another subsection that shows, okay, John and Sally are both making $80,000 a year, combined income $160,000, and today, guys, that's not a lot of money. Okay, that's keeping up with the Joneses. And guess what? That John and Sally now have to go out and get part-time jobs. That should be a subcategory of what's going on. And here's the other thing: you might have heard of a guy by the name of Warren Buffett. Right? Kind of a guy from Omaha, the Oracle of Omaha.
Yeah, he's done all right.
Yeah, he's done all right over the past 70 years since he's been investing. This scares the hell out of me. Berkshire Hathaway's cash pile has reached a new all-time high of $189 billion in the first quarter of this year.
Because he doesn't want to invest?
Well, hold on. Listen to this. $19 billion increase from last quarter, 70% increase in cash since 2022. So when Warren Buffett is sitting on the sidelines with a ton of cash,
that's bad.
He's looking for opportunities. Who did the banks go to when everything fell apart and they needed a loan? Right? Goldman Sachs.
Yep.
Right? They went to Warren Buffett. So when Warren Buffett, the guy that says, I love when the theater's on fire, theoretically, and everybody's running out, is when he's running in to buy deals. Okay, you've got job numbers that are skewed, which we've been talking about nauseum for over a year, and I said that all in one breath. And then you've got Warren Buffett at the same time, who's not an idiot, pretty smart guy, who's sitting with more cash than he's ever sat with, ready to go. And this is what I found fascinating. To put this into perspective for our listeners, Berkshire Hathaway's cash balance is larger than the market cap of Starbucks and Target combined.
How about that?
God.
How about that? And by the way, he's got it all in one room at his house in Omaha. David Hochberg, hold on. 855-56-DAVID, 56david.com. Talking about your money with David Hochberg. He knows it better than you do and I do and anybody else does. 855-56-DAVID, 56david.com. And no, none of it makes sense. None of it adds up. Rental vacancies are up. In other words, there's more places to rent. but prices have gone up as well. Does gravity exist, David?
Yeah, well, not on our planet here. U.S. rental vacancies, listen to this, jumped 6.7% in April, the highest level in the past 4 years. This is almost as high as September 17th when the vacancy rates hit 6.8. So we're basically, within a 5-6 year high since. And here's another stat I thought you'd be interested in. Since October 21, vacancy rates have surged by 3% as prices continue to increase. So, inflation for renters remains elevated and increased by 5.7% year over year this past March. And I don't understand, Econ 101, right? When you've got vacancies and you have open units, you would typically want to discount those units to put bodies in those units so they're not vacant, right? But that's not what's happening. So it's just like the smaller box of cereal and the smaller bag of chips, right? These companies and their actuaries and their CPAs are saying, we're almost at 6%, but you know what? We're going to jam it down the throats and up their backsides of the people living here and make it up that way so we don't have to decrease our rent. I don't understand that business model, but it seems to be working. And, eventually we're going to cross over. It's already happening, guys, right? You're not spending your $8 on your Mocha Loco Joco, whatever we talked about the last time I was on. Those numbers are down. You're seeing Netflix. People are cutting Netflix off. People are cutting Disney off. All those revenues are down. And you've got Warren Buffett sitting on the sideline with a boatload of cash, just sitting there picking his teeth, waiting for everything to collapse. So that's where we're at. It's going to get to a point where the balloon's going to run out of room for the oxygen to be blown into the balloon, and we're going to start to see either a pop or the balloon slowly deflate and prices come down. It has to happen.
How does Chicago compare? And the reason I ask, David, is that I have a second cousin. He just moved to California, got a 2-bedroom for less than renting in West Hollywood for less than what he was paying in South Loop here in Chicago.
Yeah. It's supply and demand, right? I mean, it's supply and demand. The landlords out there in West Hollywood or wherever in California he's at or she's at, have determined they'd rather have a body living in that unit, right? But when you get these huge corporations that own these buildings that they put up, they've got cash reserves and they know what they're doing, and that's the business model that they want to follow. Here, I just read something yesterday that a couple of huge oil manufacturing companies have closed down a number of both oil and natural gas drilling rigs because the supply was falling off, right? So add it all up, right? I mean, all of these little pieces of information go into our gigantic, macro economy. You're not shutting down oil wells and natural gas drilling facilities unless you see a slowdown in the economy, or unless you see a slowdown in the economy and you want to keep the prices high by cutting back on supply. It's Econ 101. So when I see these different pieces of information in different segments, and then you look at automobile lots, remember, right? 2 years ago, it was, you could have played cricket or have a 16-inch softball game on any car dealer lot because there were no cars. Now drive by a car lot, they're all full and they're getting ready to stack them on top of each other because the interest rates are in the 7s and they're having trouble selling cars. And it's cheaper for those that lease cars to go in to the F&I department, finance and insurance department at your auto dealer and say, hey, real simple, cost of new cars are over here, rates are in the 7s. I got a lease over here that's coming off a lease in 1, 2, 3 months. What's it going to cost me if I buy the car and finance it? Your payment's going to go down. That's why the cars are sitting there, and that's why you're starting to see 0% financing offers again. When's the last time you saw that? I'll tell you when. Prior to March of 2020, because when COVID hit, rates dropped and everybody bought cars. So we're getting to the inflection point, guys. I'm telling you.
Well, what about the other bubble? Because the credit card bubble's huge, the student loan bubble's huge. You were talking about this before anybody else that I'm aware of. Commercial real estate, the bubble, with almost $1 trillion in commercial real estate about to come due. You're a mid-sized regional bank, and you got to collect on that. How do you survive?
You're going to grab your ankles and brace for impact, okay? Because here's the challenge, right? Look at 150 South Michigan. We talked about 4 or 5 months ago. That building sold for 50% what it was purchased for in 2017. Commercial real, and why should listeners care who don't have any skin in the game in commercial real estate? Here's why. The real estate tax base that's generated is based upon commercial real estate values and residential real estate values. When those values go down, tax revenue from real estate taxes of those properties also go down. So when you've got a $151 million building off of South Michigan Avenue that sold in 2017 for $150 million, that's now going off at $60, $70 million, whatever it is, you're going to lose 50% of the real estate tax because the owners of the building are to go petition a new evaluation of the building because they have a closed sale. Everybody around them and in the city is now going to use that closed sale as a comparative value when they go to petition for the real estate taxes to drop. That's why everybody should care. And then the other thing they should care about is the banks that hold the paper on these commercial real estate. Okay? You're going to have to get those notes refinanced. If somebody's sitting with, if you bought that building for $150 million, guys, right? I'll keep it simple. And you put $50 million down. Okay, so you put a third down, you're at 66% loan to value, and you got a $100 million mortgage. Okay, now that building's worth $50 million, and you've got a $100 million mortgage. Okay, you're at 150% loan to value. No bank's going to refinance that. So the owners of those buildings are going to have to bring in at least 50 to get it down to 100% loan to value, and then another 20 to get it down to 80% loan to value. Who the hell's got $70 million laying around? And then the stress test that the banks have to do, the owners of these buildings are going to be like, hey, you know what? Great 5 years because these are 5-year notes on these commercial loans. I can't afford this building anymore. Here's the keys, foreclose on me. That's where you put the stress on.
Yeah, and with all that good news, I'm still here to tell you, whatever you need to do, buy a house, sell a house, or make the most money out of your house, your biggest individual asset, you got to call Hochberg. He can help you work it out. He can help you figure out your finances to the best of your ability. He can help you ride this out, rent the rate, what is it, rent the rate? What's your phrase?
Buy the house, rent the rate.
Buy the house, rent the rate. That's it.
Future in the mortgage industry if this radio thing doesn't work out. I got a table for you if you need help.
That's great. That's great.